Good morning, and welcome to a panel that every year, either in Hollywood or Vegas, is an important way to kick off the conference from many different perspectives. I'm going to introduce the panel in a moment, but I want to say something that should be obvious to everybody here in the room. Having done this for so many years, the AML community to me is like a three-legged stool. They're all essential to making this work. And one key part of that is law enforcement. In law enforcement, you'll see sessions with some of the representatives from there in the next couple of days. We're also going to be doing the next edition of ACAMS today. It'll be dedicated to law enforcement. And then the private sector being many of you from traditional financial institutions, those that are now part of the AML community outside of traditional banking, advisory firms, and of course, our sponsors and vendors who have their obviously own ability to help work this. But the third part of this is the regulatory community. And while we obviously know that the regulator's job is to make sure our programs work the way we say they do, make sure that our staffing is appropriate, make sure our resources are being allocated as they should be, and that we're doing what we're required to do, they have a difficult job, but I do really appreciate the fact that they're always more than willing to tell us what's working, what maybe is a challenge, and appear at this conference and many others. They do a lot of outreach throughout the year, and as Tim did this morning, I want to do the same thing. I want to right now thank the regulatory community for their participation in AML and making it strong. Come on, let's have some... Come on, folks. Anyway. So now we'll let you get mad at them as we go through this. No, just kidding. All right, so I want to introduce the panel, then I have a polling question. We have a number of topics we want to run through. And as was mentioned, obviously, those of you that are watching virtually, you can send me those comments or those questions, and we will get to those as well. So to my immediate left is Lisa Arquette. Lisa is the Associate Director, Division of Risk Management Supervision at the FDIC. Lisa's been a frequent participant in these programs, and we are happy to have you here again. Spencer Doak is the Director for BSA and AML Policy at the OCC. Spencer also has been more than willing to participate in these and other events, and we appreciate him taking the time. Lourdes Gonzalez, Assistant Chief Counsel, Sales Practices, Division of Trading and Markets at the SEC. The SEC has also been a true partner in trying to explain to the entities that they regulate what it is they're looking for, and we're going to take advantage of having Lourdes here today, and she's going to give you some issues that they are working on. In the same industry, of course, is Sarah Green. Sarah, Senior Director, Enforcement BSA Policy at FINRA. Now we have somebody who, I don't know how he got up here. Rick Small is the Advisory Board Chairman of ACAMS, but more importantly, he's the Director of Financial Crimes at BB&T, and Rick is going to give us a sort of a private sector portion of the regulatory themes we're going to talk about. And then we're happy to have, for the first time on this panel, Jeremy Kuster, who's the Deputy Associate Director, Policy Division at FinCEN. And so FinCEN has obviously done quite a bit of activity in the past year, and Jeremy's going to share some of those issues and answer some of the questions on some topics that we will put up on the board. And last but not least is Suzanne Williams. Suzanne, the Deputy Assistant Director for Corporate Governance, Supervision, and Regulation. It's a lengthy title, Board of Governors of the Federal Reserve. So again, welcome everybody. Thanks for participating. We do want to start off with a polling question. And the polling question is, my institution, firm or client, is prepared for the May 2018 implementation required under the CDD rule. So, we can't see your phone numbers here. You'll never receive a follow-up text message. Standard text messaging does apply. The answers are yes, no, no, but by the end of 2017, still struggling. So I'm going to leave that up for a few minutes. Obviously, that's the big elephant in the room for U.S. institutions, and that's the requirement by May of 2018 of having that final rule implemented. You'll see some sessions specifically dedicated to that in the next couple of days, but this is an area where we'll have a little more to say about this as we go forward in this morning's session. So I'm going to leave that up. What I want to do is start off, though, and give the folks on the panel the opportunity for some general opening comments on some things that they want to stress. We have topics that they certainly will cover, but Suzanne, I'll start with you. If you want to talk a little bit about some particular issues, no, we're going to put the topics up in a few minutes, but I want to give everybody an opportunity for things you want to emphasize.
Sure. Thanks, John, and thanks to ACAMS for inviting me back again this year to speak to the group. And I think, as always, the number and the attendance is really a testament to the commitment on the part of the U.S. financial institutions to compliance and BSA AML. So, we have a lot of potential topics to talk about. One thing that I wanted to start out with is about foreign correspondent banking. So you might ask, the rules have been in place for over 10 years now, so why are we still talking about it? Certainly it comes up in the context of de-risking, and that's the subject of a following panel. But I think that, it's important, and it continues to be important, because other than some limited areas like PEPs, it currently is the only customer type where there's a requirement in a regulation to do CDD and EDD. And I think some of the reasons we're still talking about foreign correspondent banking reflect the risks and the concerns and the challenges that still remain in determining, what's the appropriate risk level, how much due diligence is enough, what are the most important factors in making those determinations. And I think that it's perhaps a sign or a precursor of what we might be dealing with in subsequent years as the CDD rule goes into place, which will cover and make a legal requirement for all accounts and customers for the U.S. So I think we can hopefully learn from our experience with foreign correspondent banking and look at the same questions that U.S. financial institutions have faced in that area. So as far as current foreign correspondent banking issues that we've identified in our supervisory process, we looked over the last approximately 5 years, so about the last half of those requirements, and issues that had been identified during the exam process. CDD and risk rating or risk identification continues to be the number one issue. It ranges from things like failing to identify the existence of a foreign correspondent banking relationship, perhaps in non-traditional areas like trade finance or other areas that aren't just sort of a clearing account or other correspondent account. The affiliate issue remains something that some banks struggle with, is treating them the same in terms of due diligence and monitoring. And also an issue that we see repeatedly is collecting sufficient information in the due diligence in order to identify the risk and for example, information about the nature of the business or on multiple factors, not just one, such as country risk. So I think one development that we've heard about anecdotally that's sort of interesting, and this was something just recently, someone that was in the business side of correspondent banking came to me, and they were saying that it was actually their compliance staff had come to them and said that for all correspondent banking relationships, they needed to do a site visit. And in this case, the banker actually referenced the FFIC manual section that said a risk-based approach, and then that started the dialogue, again, not with the examiner, but internally within the bank about what would be appropriate and what would be, appropriate due diligence and according to the risk. So, tied to that is concerns that have been identified where the information collected, whether amount or type or the frequency of review or the type of monitoring or level of testing is not linked to the risk rating. So if you're identifying correspondent bank accounts or any other customer as high risk, medium, low risk, then that should mean there are differences in the due diligence that you conduct, the type of monitoring. So we want to see it be a continuum and that it all makes sense, that the risk ratings have some meaning in your overall system of internal controls, and that they're supported with clear rationale and policies and procedures that lay all that out. So John did ask me to talk about good practices and positive developments in this area, but in the interest of time, I'll wait and come back to those.
Great. Jeremy, before I go to you, let's pull up the final poll, and at 44%, most of you, a little bit over, a little under half said by the end of 2017 you'll be ready. 32% said you are ready, and 13% said they're still struggling. So obviously still a lot more work needs to be done, and I'm actually going to ask Rick a couple questions about CDD implementation, but appreciate you responding to that. Jeremy, obviously a lot going on, but give us a couple of highlights.
Right. Well, since Suzanne started with correspondent banking, I thought I might touch on money services businesses very quickly. As you know, we are the AML regulator from all money services businesses in the United States, and we do that in partnership with a number of different agencies and counterparts. We work very closely with the IRS for our examinations, but we also work very, very closely with the states. The states have a lot of the responsibility for overseeing money service businesses. In that regard, we have worked on some MOUs to share supervisory information. We are looking to do our own internal analysis to help find hotspots, so if you would, within the BSA data on institutions that may require a closer look, either from us or from the states. We're working on making sure that the exams are thorough and there's good coverage, but we're not duplicating effort with the states either. I think we've taken some good action in this regard. We're really one of the first agencies in the world to start addressing virtual currencies within the context of money service businesses. They are money transmitters under our regulations. That really opens up my discussion to another point, and that is culture of compliance. That's very much a priority for us. And within the money services business, within virtual currency, within fintech, I think the culture of compliance is something that we really want to stress. We do with everyone, that with everyone we regulate, but this is an emerging issue. We want people to be integrating this culture as they're starting up. Compliance, BSA, AML, compliance is not something you just sort of layer on after the business starts. It needs to be in the forethought of your business plan. We put out an advisory on culture of compliance, which details what we would expect. But fundamentally, it comes down to having that ethos. Integrating AML compliance, integrating the objectives of AML compliance at every layer. Tone from the top, certainly, but streaming on down to the operational level, to the tactical level. It becomes important because this is an environment in which it's always changing, it's always adapting. There are always new challenges. I'm thinking back to when I was a compliance attorney working on FCPA issues. Mm-hmm. When we started, FCPA programs were fairly simple. You looked at the payment side, you look at the accounting side, you search for improper payments. That was almost the entirety of the compliance program. Maybe some training here and there, some internal validation that people are paying attention, but that was about it. And it seemed to work because it made sense. Bribery, corruption, it leads back to improper payments. But then the issue of interns and foreign hirings happened and really changed the game. There were significant penalties, but no one really thought in that direction. Everything was in a silo. That's the consequence of a check-the-box compliance program. That's not what we're looking for. We're looking for the right attitude. We're looking for people who want to do the right thing in whatever they do. Because of that, it really is something that has to be built into the culture. It has to be from messaging from the top. It has to be in the decision-making process. It's why are you doing the businesses you're doing? It helps you to understand the risk. It really creates a better decision-making paradigm for the organization. And that's why we really push it so hard.
Thanks, Jeremy. Rick, one of the things I want you to comment on, if you would, you've been a pretty strong advocate that we try to figure out who needs help in the CDD implementation, and I know you're working at your institution to put that together, but maybe just a couple of quick comments and maybe recommendations you might have.
Great. Thanks, John. Yeah, so as we've been working on implementation of the new rule, I think a lot of questions have come up, and I've actually talked to a number of my colleagues, and it's interesting but yet a bit scary to get the diverse opinions on what folks are thinking about with the implementation. And so I do think there needs to be a lot of discussion around how to do that. And obviously I'm focused on the beneficial ownership part of the rule. Most other things in the rule are things I'm hopeful that we're all doing already, but beneficial ownership, for those that haven't been doing it in the past, this is a big new requirement. It requires an understanding of what it is you're going to do, how you're going to collect it, what technology needs to be impacted, how fast you can move on that. Do you need to change written applications? Do you need to change online applications? So there's a lot to think about, and that's why, John, and we've talked about this, the idea was that having conversations like today, and we're going to have some more, around what everyone's doing and try to both understand and assist each other in moving forward. One of the unknowns, and it may be a question for others to answer, is I haven't had a lot of conversations with examiners around what their view is on the implementation and what that's going to look like. The rule is the rule, but as we know, sometimes there are different interpretations, there are expectations. Haven't heard a lot about that yet, and I'm hoping in the coming months we'll start hearing more from our examiners around what their thoughts are, what their expectations are around what an implementation, a successful and an effective implementation to meet the requirements looks like.
Great. Sarah, as you're giving us some of your comments, FINRA is now going to, and transparent is probably a pejorative term, but I'm using it in a positive way, it's going to be more transparent regarding what is expected of your members, right? If you talk a little bit about that too, and then certainly any of the comments that you have. Sure,
yeah, and you know, it's interesting to hear Rick talking about the CDD rule and kind of you're kind of concentrating on the beneficial ownership. And I would say that when I hear from our members and the broker-dealer community, I've heard more questions about the expected activity and development of a customer risk profile, and would agree that that's something that, you know, is really an existing requirement and certainly implicit, if not now explicit, in the rules. But so just wanted to kind of take a minute to talk about that and kind of what we're thinking about when we think about, you know, our examiners' expectations in that area. And one thing that I think that FinCEN said in the adopting release is really important is that the requirement is intended to explicitly articulate current practices consistent with existing regulatory and supervisory expectations. So when we think about some of the existing regulatory expectations, certainly for the broker-dealer community, we think about suitability, we think about know your customer. So I think there are a lot of other rules and information that we might collect under those other rules that might be helpful for the broker-dealer community to leverage in complying with this rule. FinCEN also acknowledged that it doesn't require necessarily a separate searching inquiry under this rule to collect this information, and that sometimes, you know, understanding the nature of a customer profile can be developed based on self-evident information, such as investment objectives, such as just information about the customer that you might collect at account opening. So I think that those are the things that we are going to concentrate on in giving guidance to our examiners on what to look at under this rule. I think that Suzanne's comments that obviously not all customers are equal, right? Some customers are going to be higher risk, and for those things, maybe a more fulsome customer profile is appropriate, and exactly how you decide what you're going to put into that is obviously going to depend on your evaluation of the risk of that type of customer and that customer base. But so I think that the takeaway here is that there's not a one-size-fits-all approach, but that we're certainly going to be concentrating on the things that FinCEN mentions in the adopting release and sticking pretty close to that when we give guidance to our examiners on this.
Great, thanks, Sarah. Lourdes.
Hi, nice to be here, and I have to give the standard SEC disclaimer that the remarks are my own and not those of my colleagues or the commissioners. If I were a compliance officer at a broker-dealer right now, the first thing I would do is just pull up the AML priorities for the SEC in the exam priorities for this year and also for FINRA, and take a look at those two sets of documents, because that really gives you a good indication of what the SEC and FINRA examiners are going to be looking at or concentrating on in the following year. In terms of our own priorities, and I just want to highlight three, and I would say, I think Robert Cook, the CEO of FINRA, talked about basic blocking and tackling for your exam priorities, and I think that's really the same thing for the SEC. And we mentioned three. AML programs are not specifically tailored to the risks that are in your business. So one thing we see very often, and I went back and looked at the few enforcement cases that we do have, and you may have a great AML program on paper, you may have red flags listed on paper, but you're actually not implementing the AML program. Or you may have a new customer base, or you've doubled your accounts recently and you're not considering that in your AML program. You haven't staffed up to address those new resource challenges that you have. We brought in the last year our first standalone only AML case. So earlier, somebody talked about there are fewer AML cases being brought. I think it's new for the SEC to bring the first standalone AML case, and you will probably see more of those in the future. The second exam priority for us is effectiveness of the independent testing. This is always at the top of exam deficiencies. When we talk to examiners, we say, what are you seeing? The scope of the independent test may be too narrow. You may not be adequately supervising the independent testing. You maybe have somebody who is actually not independent doing the test or doesn't really know what they're doing. I'm always struck by the fact that in the securities industry, half of all broker-dealers have 10 or fewer employees. So we have a big chunk of the broker-dealer sector that's actually pretty small. And then we have a few very large firms. So you end up having an AML officer who's also the guy who's making the coffee. And that may work out, but it creates unique challenges in the broker-dealer space. And the third exam priority has to do with SAR filing. So Andrew Serezny, the recently departed director of our enforcement division, gave a speech at the SIFMA AML conference, I think it was about a year ago, that really just focused on the failure to file any SARs by some firms. There may be a reason why that's happening, but it's really important to take a hard look at whether that makes sense for your firm. And I think you're going to be seeing more regulatory action in this particular area.
Great, thanks, Lourdes. Spencer.
John, thank you for inviting me again, and thank you for hosting the regulatory panel. I think this is an excellent panel as it relates to opening up the conference. It really sets the stage for where where I think a lot of the topics will go, a lot of the other sub meetings will go, and so forth. Opening remarks. One thing I want to start out with is that it's important, I think, to recognize that the vast majority of the people here from the banks that are supervised by the OCC are running satisfactory BSA AML programs. That is a good thing. That means that it is just the very few that have issues, and that was actually was shown today, I think, in the discussion of the decrease in enforcement actions. What's working well in those, and we'll get into the positives and negatives later, but I think what's working well in those is that we're seeing evidence that the banks are really, the management teams are really striving to understand their risk profile. They're really trying to make sure that they have in place appropriate infrastructure to handle the risk that arises from the products they offer, the services that they're providing, the customers they're serving, and the geographies that they're serving with transactions coming to and from. So I think those are all very positive things. With regard to some of the other things on the horizon, or the things that we'll maybe be talking about even this morning on this panel, I would like to at some point talk about the OCC's issuance on foreign correspondent banking. We issued that in October of 2016, and we can go into more detail about what is in that later in this panel if there's time. With regard to exam priorities, I think it is more important now than ever that we make sure that we are expending our resources performing risk-based examinations. This is not a go in and repeat the process year after year, check the box year after year. This is really looking to decide where do we need to expend our time. Time is valuable, examiner resources are limited, as you all know, and so we want to make sure that we're really focused on those areas within banks, those pockets of risk where banks are taking risks, to make sure that they're properly managed. And so I think that's really very important to us. The OCC also has been very heavily involved, and I think we all know this, in the issue of fintech, and also looking at potentially special purpose charters for companies that would not normally have been in the traditional banking space. We stood up, or it's in the process of being stood up, an Office of Innovation some time ago, and that is looking at this issue of how we can possibly charter institutions, really I guess I'll call them, that have a different purpose. It might be anything across the gamut of fintech and other things. So those are my openings. Thanks.
Great. Thanks, Spencer. Lisa.
Good morning, and thank you, John, so much for the invitation to speak here. I really enjoy coming to this conference. I see a lot of AML CFT professionals working toward improving their skills and regulatory professionals, so I appreciate the invitation. What I'd like to do quickly is kind of discuss or kind of summarize the status of the industry, the banking industry, that is. I'm from the FDIC, and we have three roles. One is to supervise institutions, one is to ensure depository institutions, and the other, of course, is to act as receiver in instances where they fail. So we've just come through a pretty significant crisis, and it seems like we're past that, but this has been a very slow recovery, one of the slowest since the Great Depression. And at the height of the crisis, when we started out, we had about industry-wide 91 problem institutions. That means that they were at greater risk of failure. That was in early 2008. At the height of the crisis, we had close to 900 banks on our problem bank list. We're back down to 117, and that crosses all banking regulators on the panel. So we're down to 117, which is a good thing. There's been an awful lot of consolidation that has affected probably many of you in the room, as well as many of us. And during the same period of time, there have been, well over 500 bank failures. So what does that mean to you as an AML CFT professional? It could mean a lot of things. You may be working for another company right now, another bank right now. You may be working for something that looks a lot different than it did before the crisis, a bank that has either acquired multiple institutions, that has merged operations, or maybe you work for another institution entirely and have another regulator. The way that's affected you, it's also affected us. You've probably had to wear an awful lot of hats during the crisis, fill a lot of roles, while trying to keep your focus on Bank Secrecy Act compliance. That can be difficult and challenging. It can be difficult and challenging for a regulator as well, so I think we recognize that. But two things that I'd like to say in that regard. One, the banks that we supervise, overall, the vast majority have a satisfactory Bank Secrecy Act compliance program. In fact, on average, and this is year after year after year, the FDIC issues around 1% of the institutions that we supervise, 1% formal actions related to the institutions that we supervise. That's not a lot. That means that 99% of the institutions that we supervise are doing at least an adequate job. And adequate is good in terms of a report card, right? Because we are there on site once during an exam cycle. The ones that you hear about, the ones that you see, are the ones that probably have some significant failures in their BSA compliance program that are pervasive and over a long period of time. They do not represent the entire industry, and generally those enforcement actions don't stay in place for a significant period of time. It's a means to correct compliance problems. So in terms of taking stock, which is an issue that I thought would be very relevant, and I know it's relevant to many of you in the room. I know it's relevant to John, because I've seen your blog. But you know, the Bank Secrecy Act has been around for nearly 50 years. And we're all thinking, you know, it started out as a means of collecting data. It started out as a means of being transparent and to contribute to tax evasion, something like money laundering criminal investigations, if you will, almost 50 years ago. We're still in the process of collecting data, aren't we? But it's expanded. Definitions have been put into this. There's, you know, money laundering has been criminalized, terrorist financing has been criminalized. Who knew 50 years ago? Well, I don't think anybody did. But the means of collecting data has become more sophisticated as financial crimes have grown and become more sophisticated. As the borders have melted away and transactions occur almost instantaneously, banks can become more vulnerable. So your job is that much more important. It is difficult to be the gatekeeper of financial transactions, but it is critical and it is important. And to repeat, you know, 99% of the banks that we supervise are doing an adequate job. Some are doing a good job. But I would like to say that over time, you know, the industry has consolidated. Banks look a lot different. There are many, many large financial institutions, and the smaller, sometimes weaker institutions, they're gone. The community bank profile has changed. Right now, the number of insured institutions is a little less than 6,000. When I started, you know, the numbers were much, much higher, about 17,000. The number of assets total about 16.9 trillion, while the deposits total about 12.9 trillion, and that's all of the institutions that we supervise. The number that we the number that we supervise is about 3,748 with 2.2 trillion in deposits. So we've got a significant job, you've got a significant job, and the risks have increased. So one, I want to applaud you for being here to work on improving any skills that you need to improve, keeping up with the changes, and recognize that you all are doing a good job. And two, while you take stock, we're taking stock. And the last point, and I promise, the federal banking agencies issued a report subject to the Economic Growth and Regulatory Paperwork Reduction Act. We call it AGRIPA. So every 10 years we have to evaluate all of the rules that apply to banking organizations, and the Fed also looks at holding company rules. Well, one of the largest areas of concern was the Bank Secrecy Act. Now, we all have Bank Secrecy Act compliance program rules, and we have suspicious activity reporting rules. But what we did with all of the concerns was we shared them with Treasury and with FinCEN so they could factor that into their calculus about things that they might want to consider, things that they might want to do. And we also, you know, recognize that this is an area of concern and importance. So I just want to say we've heard you, and we've shared all of the concerns, and we are considering issues along with our colleagues at FinCEN. That's it.
Just to add one aspect of the AGRIPA report, which does affect BSA compliance, is the raising in the asset threshold of community banks that are eligible for the extended exam cycle of 18 months. So because your BSA exam is usually conducted with your safety and soundness exam, then the effect is that there's going to be, for an additional number of institutions, a greater length of time between BSA exams.
So it used to be institutions that were about 500 million and below had an extended examination cycle, so long as they were well capitalized and well managed. Now that threshold has been bumped up significantly, and it's institutions of $1 billion or less that are well managed and well capitalized are examined once every 18 months. So that's like a 6-month break. We heard you. Good point, Suzanne.
And the Agrippa report lays this out in more detail. But among the BSA issues that were raised either in comment letters, there was a series of town hall meetings. The CTR threshold was the number one issue that had been raised in terms of people expressing a desire to have the threshold raised, and that hasn't changed since the 70s. So as Lisa said, we summarized and shared those comments with FinCEN, and FinCEN included a letter. It's in the Agrippa report if you're interested.
I'll have nothing to say about the CTR threshold.
Yes.
Although it has been under consideration for many
years, exactly.
Yeah. John, if I could add on the CDD, you had asked, or maybe it was asked, about the exam procedures. So they're also in development. That's why nobody's been talking about them. But as was reflected in the polling question, 2017 is the year that both the industry and the supervisors will be sort of gathering and developing what will be the supervision for that particular aspect. Just a couple additional points. As I mentioned, based on all of our experience with foreign correspondent banking and other areas where there has been an explicit CDD requirement, I think there's an opportunity for industry to perhaps develop some consensus about risk factors and appropriate due diligence for categories of customers. CDD requirements to date have been, what we've seen is it's generally, I would call it more of a bespoke process, right? It's your private banking clients, it's your large net worth, it's foreign correspondent banking, it's potentially other categories that that you have identified as potentially high risk, because of course that's a requirement under CIP, is that if your customer, you have a risk-based process to look through your customer to identify and collect information on beneficial owners. It's not a universal requirement. So I think the impact is going to be in the lower risk customers because in terms of collecting this information, because the prior focus has been on high-risk customers. I think another aspect of what banks need to be considering as they roll out these, these systems for collecting the information is then how that information is going to feed into your other controls. So as I mentioned, that there's continuity and between identifying customers high risk, what that means for due diligence information you collect, how you monitor them, but then also I would be very surprised if once you implement these systems that everybody's exactly in the risk bucket you thought they were, right? So as you collect that information, and if that information lets you know that their risk profile is different than what you originally thought, or as the customer transacts and does business over time, it's different, you need to have that following loop into your controls and have it, again, inform your risk rating and sort of start the cycle again. So that's another aspect that I think we haven't talked about too much, but needs to be considered.
Rick, that sounds a little difficult, no?
Yeah, I mean, it actually sounds very difficult. And Suzanne, one of the things that concerns me greatly is that if you're working through what the examination procedures are going to be, and we're going to hear about them at the end of 2017, if you saw the polling results, a lot of folks think they're going to be done with their implementation by 2017, by the end of 2017. And that's the knowledge cycle that I think that we need to understand. If there's an expectation coming out of exam procedures that we're not thinking about and we're already making, and some banks that I've spoken to are spending millions upon millions of dollars, not out of a desire, but out of a necessity to change systems. If there's an expectation that we're not yet aware of, knowing that sooner rather than later is going to be extremely helpful as we move forward in the implementation.
So I agree, and I think ACAMS and other industry groups serve a good role in, as these questions come up in implementation, of sharing those with, well, it's FinCEN's rule, but with all of us that will be involved in the process. And I mean, the expectation that I described is consistent with and is already there in the FFIC exam manual, in the CDD section. It's just the application, because of the expansion of the CDD rule, is going to be broader.
I want to shift gears just a little bit. Some of our topics we're going to sort of meld together. Lisa's already talked about sort of taking stock. The shifting role of BSA interests me, and I think FinCEN's a perfect example of that, right? Because BSA today it's banking, it's gaming, it's insurance, it's securities, fintech, MSBs. Didn't used to always be that way, so that's part of it. But if you're in a traditional bank like Rick is in, he has to have himself the skill sets expanded, or he has to hire people that have those skill sets. So I want to talk about that from all of you. I also want a little more drill down on sort of exam issues that you're seeing, good and bad. And let me just say, you've given us some of that already. You know, Kieran talked about the enforcement actions going down, agreed, and Lisa talked about formal actions going down. But MRAs and MRRAs are still pretty frequent and pretty common. And so you have to spend as much time and energy and resources to do that as you would almost with a consent order. So it's serious. You got to take exam criticism seriously, as everybody on this panel would agree. So giving the attendees, you know, some direction on what are you seeing that's problematic, and SARS might be part of that, Spencer. We'll talk about foreign correspondent banking a bit as well, but also you know, understanding what you're seeing that you think is fairly robust. We've talked before, and I think Lisa's used this term and others, blocking and tackling, right? And you said it too, Loris, I think, that sometimes even though we've been a mature AML community for 30 years, missing some of the basic stuff from time to time, which is really sort of strange if you think about it. So what are you seeing specifically there? And then what's working in certain size institutions that could be models for others? So I want to do that, but the first question to you, Rick, is in 2017, as you put a team together, obviously recently came on BB&T, everybody, it's public, you have a consent order that you're working through, but more importantly than that, 2 consent orders. More importantly than that is, as you're building a team, I would argue, tell me if I'm wrong, it's vastly different or more expansive than it would be when you built a team at Citi 20 years ago.
Absolutely, and it's a great discussion point, because even 5-7 years ago, thinking about, for example, looking for somebody that has AML skill sets and technology background was not something that we would do, because we would rely on the technology function within our institution to manage that, and we would talk to them about our great dreams, our hopes, and what we needed to do for day-to-day, figuring out CTRs, figuring out suspicious activity. But now, and I've brought in the beginning of a team that both have that AML expertise but also have technology expertise, because you need to meld those together. Another area, and this goes back probably a little bit longer, but I would never have envisioned an AML executive to be an operations have an operations skill set. So you'd rely on somebody else to be the operations person. I think that's very difficult to do in the environment we're in today. I know some banks, and especially some larger banks, have recently split sort of the AML policy from the AML operations. I don't agree with that model, because I think then you lose the melding of those two issues together. And to your point, John, about the consent orders, and I'd be interesting to hear from my colleagues, is that in a number of recent enforcement actions, and full disclosure in the one we have as well, there's a requirement that we have to do a skills assessment to ensure that our AML team has the appropriate skill set. There's no definition around what that is, so again, we're still thinking through what that all means.
Spencer, let me ask you, just high level, what does that mean, appropriate skill set? Makes sense, high level makes sense, but to Rick's point, not the specifics of his bank, what would you, if someone called you and said, hey, I'm staffing up, what would be sort of a general recommendation?
So the immediate thing that came to mind for me is, what is your risk profile?
Uh-huh.
If your risk profile is such that you are sitting with a consent order right now, or 2 consent orders in Rick's case, unfortunately, I would highly suspect that you would be looking for people that would be able to address not only the characteristics of that consent order, but also the issues that are popping up because of the risk profile of the institution. Again, I mentioned it earlier, but briefly, the types of products, types of clients, geographies, and so forth. That doesn't just mean somebody that can address a specific client type in general. It means somebody that can handle the deep nuances of the clients based on the volume of the clients, based on where they're doing transactions. So it's deeper than just the product type, the client type, and so forth. It's about what is behind the scenes on that as well.
Lisa, sort of a reverse question. If it's sort of expected that institutions upgrade their or expand the skill sets of people, how does the FDIC, and sure the other agencies can opine, how do you make sure that either your examiners or the resources the examiners tap have that broad-based knowledge as well? Because again, just an educated guess that examiners have broad background in looking at policy and procedures and programs, but with all these new products, financial technology, it's hard to master all of that. How do we ensure, or at least try to make sure, that a bank that's being examined by somebody has the same expertise as they expect the bank to have?
Great question. Didn't expect that, but I totally appreciate it. Honestly, we recognize that because things have changed, the banking industry has changed, the types of banks that we supervise have changed, and through Dodd-Frank, we have another role of overseeing certain institutions from a looking forward perspective, from a potential resolution perspective. So we're on site at lots of institutions. And how do we make sure that our staff has those skills? Because we did a lot of hiring during the crisis. We're developing a technical competency model at the FDIC. Didn't plan this question, but we're developing that to make sure that we know where our specialists fit. We have well over 300 AML specialists in our examination force. So all of our risk management examiners also know how to conduct Bank Secrecy Act exams, but 300 of them are our specialists. And we're developing a technical competency model to kind of figure out which ones have specific and precise skills to deal with certain types of product, services, and relationships, like, for example, foreign correspondent banking or certain geographies, private banking, where they have skills. So we're doing that, and we're also developing kind of a training tool to address areas where they may need to improve. We have a team nationwide that might be available to go to institutions with specific problems or specific types of customers. They may have expertise in San Francisco or Los Angeles, and they might be going to Miami because there's a specific need. So we are clearly dealing with that because we recognize that we all have different skill sets. I had different skill sets before the crisis. Before the crisis, I was very focused on anti-money laundering and kind of our general reporting of all risks. And then I picked up applications for deposit insurance and mergers and changes of controls, stuff that I hadn't done for a while. Thankfully, now I'm very much more focused on AML, cyber fraud, and financial crimes, but we're all going through different types of growing pains, including our staff, and we're addressing that because you're right. We need to make sure that we have the right examiners at the right exams and that they travel where they need to travel and get the training that they need to have.
And John, on your question about enforcement actions, so certainly there's been the numbers and change in terms of new enforcement actions, but something that I know we're looking at, and I think many of the other agencies are looking at, are enforcement actions that are, shall we say, well-aged and have been in place for a number of years. And so if they haven't been lifted, the question is, what's the reason? Is it that they're nearly in full compliance? There's just some element of testing and validation and either internally or externally that needs to be done? Or is it a situation where there's a potential need for escalation because both the bank and perhaps even the board haven't focused enough attention on it, or just what the story is. So it is important to look at the numbers of new enforcement actions, but there's also the enforcement actions that were put on 5 or so years ago that are still outstanding, that as supervisors and as compliance professionals we're still dealing with. As far as the best practice related to enforcement actions, one thing that we've identified and have been looking at recently, not just in the AML context, is what what senior management at the bank is doing in reaction to the enforcement action. Obviously, the first thing that you have to do is manage it. There's a lot of project management that is required. But what I'm referring to is some type of lessons learned review, or some people call it root causes or holistic review of other areas of your institution where maybe the same issues exist or could exist because of the control framework. So we're hoping that the firm's response to an enforcement action isn't just limited to the specific provisions and the specific issues that were pointed out by the regulator, that they take the opportunity to assess what that might mean for the controls or the business practices throughout the organization.
Jeremy, I want to bring you back in the conversation for a second and mention, I think you're sort of the model for the shifting role of BSA, because FinCEN has this broad area of coverage far beyond traditional banking. And you have been issuing penalties against the gaming industry and other industries. Just from a very, very high level, how does FinCEN manage all the disparate groups? You obviously have staff and you have people on loan from enforcement agencies, from law enforcement, all that good stuff. But the breadth of things, and then in terms of advisories, sort of peeking behind the curtain, how do you guys decide, we need to get something out? Culture compliance applied to everybody, right? But when you're talking about some of these other entities that are fairly new to AML, how do you approach that? I know you do some outreach. How does that work?
Well, I think it sort of ties together two things. One, skill sets, because even if we had detailees that incorporated every person from all these other agencies, we wouldn't be able to cover every single institution under our purview. So we have to be able to leverage the expertise of others. And I think that's an important skill set for everyone, wherever you are. I grew up in the Intel community, and I did that post 9/11, where there was a shift from reliance on subject matter expertise. Every analyst became a subject matter expert in something. Right. And that started to shift because there were too many dynamic issues in play. There was too much information to be able to absorb, and too many current issues sort of hijacking the agenda. I think a lot of people will find that to be a fairly familiar scenario. You couldn't spend these 7 to 10 years becoming a subject matter expert. Some people did, and it's important that they do. But what people had to learn was how to identify, evaluate, and leverage expertise from elsewhere. You had to have discernment, judgment, you had to have good research skills, you had to understand data and how to apply it, you had to understand technology and how to apply it. And I think those are some lessons that we've incorporated. We use our liaison office, we use our intelligence division to drive how we target our sort of meager resources. We do a lot more internal analysis of the Bank Secrecy Act database. We try and find trends, one, to inform our own activities, but also to give you all a heads up as to some typologies that we are seeing. And we do that through the advisory process and through other channels as well. But that's generally how we adapt to a much larger landscape. It's using the data that we have, that you provide to us, and helping us really fill the gaps. One of the metaphors that I use to explain the difference between Prudential, I'm probably going to get this wrong, so apologize. Prudential and BSA regulation enforcement is, BSA is the concrete slab of the house. Can't have any cracks. You get cracks, water gets in and it degrades the entire house. Prudential can be more of a framework. It can have some space, but it does have to have those key leverage points to keep the entire structure up. It's different. You can allow some smaller institutions to sort of not be systemically important from one perspective. But for BSA, that's just a gap. That's something that can be exploited and has been exploited. So we have to have as solid as a regime as possible. And to make sure we're doing that, it's all about leverage.
John,
Sarah, you going to say something?
I just wanted to comment, give the securities industry perspective on a couple of things you've mentioned. You mentioned examiner training. I think that's so important in this area, right? This is a risk-based area. And what that means is that there's room for interpretation and subjectivity. And so having highly trained and experienced examiners is so important in this area. So one of the things that we've done at FINRA is develop this dedicated examination unit, right, that just does AML exams. And not only do they do their own exams, but they also provide expertise and technical assistance to other examiners and to other exams as necessary. And we have found that this has really produced much better results, I think, from the perspective of the firm and from FINRA. We also have a team of regulatory experts, again, who provide technical assistance throughout our 16 regional offices throughout the country, right? And making sure that we have the expertise that we need for different types of firms and different types of AML examinations. I think Lisa was talking about, we have a very risk-based approach to examinations. We have 9 risks that we evaluate all of our firms on. Anti-money laundering is one of them. And we look really carefully at what we think are the risks in that area. And so when we go in and do an exam, we're going to be really focused on the information that we've collected beforehand and what we think the risks of your firm are. So we might not examine anti-money laundering at all. We might just examine a specific area, but it's going to be heavily data-driven, and it's going to rely on a lot of surveillance that we do before we go in and conduct an examination. You asked about what firms are doing well, and when I think about kind of what I see as the differentiation between what firms are doing well and the firms that aren't doing as well. And I have in mind, particularly, Laura just mentioned, we have a lot of smaller broker-dealers that we regulate. I'd say documentation is really the key. There are a lot of firms that really know their business, know their customers, and they know their risks. Not all of them document all of these facts. When we come in as examiners, it's hard for us just to take your word for it, right? That you know the customer, you know the business, you know the purpose of a transaction without having something documented to give us some comfort in that area. So I would say that is really a good differentiator when we go in and we see, we didn't file this SAR, but we have documentation about why we didn't file the SAR. We considered it, and that is really what we see in the programs that we think are doing a good job, are firms that do a really good job documenting. And finally, you had asked about examination issues and examination priorities. As Laura just mentioned, FINRA issues an examination priorities letter every year. Great guide for those of you who have a broker-dealer to concentrate on and see what we're going to be focusing on in the coming year. We talked about a few areas in the AML area, and some of them I know we're going to get to later on in this discussion, but a couple that I just wanted to mention off the bat is delegation. We've talked about that a little bit in this area with respect to technology and operations. You guys in AML cannot do it all, right? In order to have an effective anti-money laundering program, you are really going to rely on almost everybody in your organization to help you out. Be it the customer-facing individuals, be it operations, be it technology. It's got to be an all hands on deck operation. And for that reason, it is critical for you to, again, document in a policy, in a desk procedure, in some other type of writing what you see as what you are relying on these other parties to do for you. Similarly, testing. Making sure, to the extent that you are relying on certain parties, certain other areas, certain departments to escalate things to you, making sure that they are indeed escalating those things. You want to make sure that everybody has the same understanding, right? When we go in and we do an exam, we'll talk to the AML department and we'll say, tell us how you monitor for this. And they'll frequently say, well, we do this, and then this other group escalate these things to us and they look for these things. And so what we do second is that we go talk to that other group and we say, tell us what you understand your role to be in anti-money laundering. And I can't tell you how many times it's different from what the AML department has told us that they think. So it's just so critical for you guys, really, mainly, for your own assurance, to make sure that everybody has the same understanding about what they're doing. And then, again, periodically, to the extent that you can do it, testing that to make sure that if there are certain transactions or certain things that you're expecting that this other group is doing, making sure that they catch what you think that they're catching and sending it on to you. And that is really critical, I think, for your job and to help you do a good job at what you're doing.
Lourdes, as you weigh in here, you mentioned one of your priorities, the governance, and gaps in governance, and I'm particularly interested in that because I think that that's an area, it's sort of similar to culture, right? You're making sure, and what you just said, Sarah, the structure of the organization, so I'm curious about that, but more directly, what are you seeing that needs improvement besides the priorities that you mentioned before?
So let me actually just round out what Sarah was talking about to begin with. First, we do have in-house expertise at the SEC. We have something called an Office of Market Intelligence, which is a group within the Enforcement Division. They're the ones that do the SAR triage, and they're an office of fairly recent vintage. You talked about BSA being around for 50 years or so. For the securities industry, for broker-dealers, has really been after 9/11. That's really when broker-dealers have come into compliance with BSA, because it was imposed on all broker-dealers after the USA Patriot Act. And it still hasn't been imposed, by the way, on investment advisors. That's a rule proposal that is still outstanding with the Department of Treasury, but that is something that is in the works with the Department of Treasury. I would say, so we start with this Office of Market Intelligence, which is a SAR review unit oftentimes. And typically, I was trying to think as we were talking about the types of SARs that we at the SEC will see, and oftentimes is market manipulation, insider trading, Ponzi schemes. There's been a spike in elder financial abuse SARs because we're really focusing on that, and FinCEN has focused on that as well. We meet, Sarah and I, and examiners, so I'm on the policy side. We meet quarterly with examiners, enforcement, FINRA, SEC, and go over issues of common concern. We also we go and we speak to the SIFMA AML committee, and we speak to firms independently as well. And we hear from firms, well, there's a rogue examiner who cited a deficiency, and I know it isn't a deficiency. And I always go, is it really an area of disagreement? Because at the end of the day, this is a risk-based system, or do you really have a rogue examiner? So I would say in terms of news you can use, if you believe that there is in fact a rogue examiner, and this gets to the expertise point, you can always file with the SEC something called the TCR. We have something called Tips, Complaints, and Referrals. It's a system on our website, and it doesn't look like it applies to examiners, as I mentioned. But if you have a real disagreement, this is something that you can use. And firms have used it. They have filed in our SEC system, we have an examiner and we have a complete disagreement with what they're saying. We will, on a quarterly basis, discuss exam issues of importance. So there may be a fact pattern where FINRA isn't quite sure how to proceed, and we'll meet quarterly and we'll go through the fact pattern, and then we'll go back and say this is what we think the answer is. And we also meet with the banking regulators as part of the FFIAC meetings we go on a quarterly basis as well. In terms of governance, the one thing I would say, I talk to a lot of compliance officers, and they feel like they are personally responsible. They're personally on the hook. And the first thing I would say is compliance is the firm's responsibility, more so than an individual's responsibility. So we're looking for the firm to be responsible. We have had failure to supervise cases involving AML. That is true, so has FINRA. We have brought cases against compliance people. That is very rare that happens. That is possible, but very rare. But it is the firm's responsibility. In terms of our own enforcement cases, under-resourced AML compliance functions is a common theme. It may not pop out when you look at the orders, but it is a common theme to the orders that we bring. So you can go back to the people who have the purse strings at your firm and say, look, this is a common theme in the cases the SEC and FINRA brings.
We could spend a lot of time on the topic that was on the last page, SARs, and I don't want to do that because we have a lot to cover, but I do want to give, Lourdes just mentioned a couple things regarding the SAR filings of some of her members. I just want to throw out to the panel anything in particular in 2017 regarding SARs, and out of the whole panel, the only person that's actually written the SAR reg is in the private sector, and that's Mr. Small. So this has been around for quite a number of years. So starting with you, Jeremy, obviously you guys compile the tips and trends, the statistics and all that, but just in general, we've seen some groups that have met recently and have talked about the SAR regime being relatively dated, but for my money, didn't really offer any sort of coherent response to that other than to say that fact, which is true, but okay, what do you do next? From FinCEN's perspective, because you're the repository, you give out a lot of guidance about it, you crunch the numbers, you get them out to law enforcement, high-level view of where we are with SARs in 2017.
It's a tough question. The overarching response is we value the SARs that we receive. It's very simple. They are used, they're used by law enforcement, they're used by our internal analysts. They support cases, they support typologies, they support policy making, they support outreach. The body of the SAR database is the most important thing that we have, which is not surprising. That's why we were designed. It makes sense. Recently, over the last 6-7 months, we've put out a few advisories related to cyber issues, email compromise, as well as cyber-enabled crime. I think that is something that we are focusing a little more attention on. We see the vast amount of data that financial institutions collect that is cyber-related. More and more banking is done, banking services is done through cyber-enabled activities. Therefore, you have ISPs, you have IP addresses, you have subject emails. You can give us a lot more data about how financial crime happens within your financial institution than we did before. And that has turned out to be an extremely valuable tool internally to help identify new typologies. But we've also gotten very good feedback from law enforcement that this is really helping them move the needle on cyber investigations. And as you know, getting information to us in a timely manner is critical, and we're seeing that in the email compromise scenario. We've partnered with law enforcement to use our liaison relationships to contact counterparts overseas. When we are given timely information, when law enforcement is given timely information about email compromise, we can go to our counterparts and try and get the money back. Can't do it in all cases, but we've gotten somewhere in the nature of 250 million, don't quote me on that, but it's around that magnitude back over the since the program began, and I believe late 2015.
Great, thanks. Jeremy, I'm going to go to Lisa in a second, but I would just say for my money, I think that's the strongest part of the BSA regime is the filing of suspicious activity reports. And obviously we have to figure out you're filing the right ones, you're getting the right guidance, but there's a whole host of information out there. So anybody that quibbles with the end game is obviously misstating what that system is about. But there's a lot of questions regarding how do you do it, how do the regulators oversee it, and all of that, right?
And there's one thing I wanted to add to that, and that is,
I'll go to you after.
There is, some of the proposals talk about prioritization, and I think that's something we should definitely explore. But again, from my background, it's sometimes a scary thing as well. If you focus all of your reporting on these 6 issues, you're never going to know about the 3 emerging ones. And that's one of the benefits of the size of our database, is identifying new issues for y'all. And we can't do that if none of that is being reported.
Right. Rick and then Lisa.
Yes, so I totally agree, and the guidance has been great. I think the challenge still is, at least that I see and I hear from a number of colleagues, is we're sort of two regimes. So the guidance is really forward-thinking, whatever the guidance is. So cyber is a great example of areas where we as banks should really be looking, we as institutions should really be looking at new activity, providing the information that the government needs to manage that. At the same time, we're still kind of stuck, and I think, John, this is your point, in a regime where there's criticism because a phone number was left off of a SAR. So with law enforcement contact, we didn't add in a phone number. And I'm not saying this is me, I'm saying this is what I'm hearing when I talk to others. And so there's criticism around that. So it's the check the box mentality along with the thinking about the forward thinking. And there really needs to come a balance on this. I was recently in a conversation with another banker who said that in the course of a conversation around the cyber guidance, that an examiner said, if you don't follow the guidance, we will cite you for a violation of law under the SAR reporting. Guidance isn't law. I get it. That's where we really should be thinking about. But that sort of dichotomy of we still have to check the box versus let's be forward thinking, I really do think impacts our ability to really do things that we're all very interested in. We've talked about cyber, we've talked about human trafficking in the past. Those are areas where we can really impact a change in society. And we just have to think more broadly about how to get out from under regimes that have been around. BSA's been around for 50, SAR regime, the new one, has been around since 1996. So we do need to be thinking about how to get ourselves out of some of this entrenchment.
And I think, so I guess it was 4 years ago when FinCEN greatly expanded the data fields in the SAR information collection. And there was a lot of discussion at that time about, and which resulted in an identification of the fields that are considered identified as mandatory versus the ones that are nice to have or collect or whatever. So I think sometimes, whether the examiners or the bankers have forgotten about that there are certain fields that are mandatory, but there are many other fields that are not mandatory. And so, that's a discussion that came about when it was expanded. So any FinCEN guidance about requesting key terms, you're right, it is voluntary. It isn't, it's for their benefit in searching. It's not a regulatory requirement. But I think it gets to the broader point that every advisory has, every guidance piece has just added, right? So there's I don't think ever been an advisory about what's a low risk situation, or what are we taking off the form, or what are we not collecting on. I understand your point about priorities in terms of focus for law enforcement and agencies, but if we're trying to be forward looking and addressing new issues, there have to be some old issues that maybe we can stop looking at. And I think that has not yet really been part of the discussion in a meaningful way. It isn't that anybody wants to destroy the SAR regime, but I think the focus has to date only been addition and never subtraction.
Lisa.
Thank you. To one point that you mentioned, Rick, when you talk about a technical issue, I don't think that you would find an FDIC examiner citing a violation. They may bring it to the attention of management and an institution because it was part of the exam finding. Technical issues, I don't care about small technical things. I do care about pervasive systemic issues across an enterprise, and so that's important, but, so that's just a little thing. And we do document in our examinations, it's kind of an exception-based process where you see all of the issues. So it's kind of, when you get a report card, nobody likes that. I don't like that. Banks don't like that. But keeping it in perspective, that's really just the findings. But SARs for us, I know they're not intended for the regulators. I know they're not. I know they're intended for law enforcement. But I've had occasion just recently to read about a couple hundred of them. Haven't read a bad SAR yet. The banks that are filing SARs have done a really good job investigating issues associated with customers. And what I've found is customers might lose a banking relationship and then they move to another institution. And that creates a very helpful trail, I think, for law enforcement and for a regulator when we're risk focusing. Again, I have seen some extraordinary research by banks when they have developed the text, the content for SARs. And again, if a phone number is left out, I'm cool with that. It's the content of the SAR and being able to reach out to that institution to get more information that I think is very helpful. And how do you really use that database and exploit it as best as possible? And I mean exploit in a good way. How do you get what you need to get? I know that's something that probably FinCEN and law enforcement struggle with, but there's great information in there.
Right. Spencer, I want to shift to foreign correspondent banking, but if you don't mind, we got a question from our virtual audience that's connected to this. I'll just read the question and then obviously want to hear about the guidance and your thoughts. The question is, we have seen a lot of de-risking of Caribbean banks. Can you comment on the issue of de-risking as it relates to correspondent banks in countries that do already have CDD requirements in place and legally enforce, especially against the backdrop that these CDD requirements are not yet fully implemented in the US? I don't know that the second part of that is really relevant to the question, but obviously we're going to talk a little bit about inclusion, but there'll be a whole panel on that after us. But as you think about that, and obviously what has the OCC opined on correspondent banks, which I know the other agencies have said similar things.
Thank you for that, and thanks for the question from the virtual audience. The question around de-risking, which I would really like to change to risk reevaluation. I don't think that, it's...
I'm sure you would.
I don't think necessarily, reevaluating risk, rethinking whether an account fits inside of your risk appetite or whether it's manageable is a bad thing. It's actually a good thing. That doesn't mean that necessarily termination is a good thing. It means that it has to be fully vetted and fully thought through. I've spent a lot of time over the past about 4 years traveling around to various locations around the world, Mexico, the Caribbean, overseas in Europe and so forth. And one of the things that is a consistent theme, and especially in the Caribbean, so I'll address the question there, is that there needs to be a way to be transparent. There needs to be a way to fully interact with the U.S., the upstream correspondent bank, that will give them a comfort that what is happening through the account is actually legitimate, that it's business as usual. What I see often is that there are, sometimes parties that are reluctant to give information. Sometimes they can't give information due to legal requirements. But responding to requests for information is probably the most challenging and the most important thing that you can do to maintain these accounts. I don't know if that gets to the crux of the question. John, if you want to follow up on anything, I'll be happy to answer that. But let me move into the foreign correspondent issuance that we issued, or the guidance document we issued back in October. The OCC put out a bulletin in October that was really the culmination of quite a lot of work, a study that we did of several institutions that we supervise that have the larger portfolios of foreign correspondent accounts. And what's important to note about this is that we decided to build a document out for the industry, for the exam staff and so forth, that would clearly articulate our long-standing supervisory expectations regarding risk reevaluation. This is not new. That section is just restating what we've always known. So that is that, we expect banks to periodically reevaluate risk. We expect banks to take into consideration, all the various characteristics of the client relationship, and then make decisions that are well-informed through metrics and through other, information that will give them enough information to decide whether they can keep the account or whether they might need to consider termination or make changes to the account. What is important, I think, about this particular piece of guidance, though, beyond the restatement of all the supervisory expectations, is the fact that we included a section in this that talks about best practices. This has probably raised the most questions, the most concern, the most uncertainty, maybe is a good way to say it. So I will try to clearly articulate right now that these are truly best practices. This section that gets into the nuances of financial inclusion to some degree. It gets into the issue of trying to maintain the accounts, trying to talk through with the client, the subclient, whether there's more information that can be obtained, whether they might be able to reduce some of the services that are being offered to lower that risk profile. All of these things are best practices. And what we mean by that is that we expect our exam staff, OCC exam staff, to have discussions with banks that have foreign correspondent accounts around these best practices, but not to take action in the event that a bank has decided that, that just doesn't work for us. They've made a decision for whatever reason, it's not fitting their model, their strategy with regard to handling of these accounts. So that means that we would not take action for a bank that has decided not to follow that section of the guidance. And I think that's the most important thing that many of the industry representatives have had trouble with, is making sure that examiners are not holding them to a standard that is different than what the guidance is articulating.
Anything, Suzanne, you want to add on correspondent banking?
Yeah, actually, there's some good practices that we've identified and also some distinctions that we identified in terms of when issues led to enforcement action. So as far as some good features that we saw in foreign correspondent banking, they include if there was quantitative data that supported the risk assessment, things such as transaction volume and types of transactions or business relationships. Looking at the past 5 years with foreign correspondent banking, in some cases the difference between having perhaps just a subpart violation or an MRA or MRIA versus an enforcement action, one of the points of distinction was whether the foreign correspondent banking issues were isolated or if during the exam or in other exams the team had identified that there were other compliance or management or governance issues at the bank. So the foreign correspondent banking issues were just seen as part of some broader issues. One thing to remember is that in the interagency enforcement action guidelines, the key component in decisions both in whether to do an enforcement action or the severity is the supervisor's assessment of management's willingness and ability to take corrective action. So that's a key factor in how we view these individual deficiencies. Another key thing that we identified is whether the foreign correspondent banking issue was, again, isolated, perhaps more technical, or if it was really the starting point for a problem, say, the risk identification wasn't appropriate. Did that then mean that the level of due diligence information and the type of due diligence information was not adequate? Did that then mean that the suspicious activity monitoring was not meaningful for these high-risk accounts? So again, we have sometimes see these initial risk identification issues have a cascading effect and really impair the ability or the strength of the overall system of internal controls. Another good practice that we've seen is that there's trend analysis of the data and the supporting information in the underlying risk assessment. We also see it as a good practice that the results and key information are reported to senior management and perhaps up including to board committees. We also are looking for policies and procedures that cover the entire life cycle of the foreign correspondent banking. So as Spencer mentioned, certainly it's important to describe scenarios when you might decide to exit. It's equally important to describe the factors and the reasoning when you would onboard customers or keep customers or take them on. So and there should be escalation built into that at every stage. So if you're collecting due diligence information on a potential foreign correspondent customer and it meets whatever triggers that you've established, there should be an escalation process up to committees or senior management for those kinds of key decisions. So appropriate escalation of decisions at all points on that life cycle are important. We are seeing as a positive step also, especially for globally active banks that operate in the US, that this risk assessment is done across the global organization on their correspondent customers, not just relative to the U.S. piece of the relationship. I think pulling that information together and making a decision for your organization about the relationship is a good practice. And as Spencer mentioned, this issue in the relationship between the U.S. bank and the foreign correspondent bank, having the expectations, responsibilities, what products and services they will be able to use, having that all established up front, whether in a contract or the terms of the arrangement, is a good practice that we see, so there's not sort of surprises. And also, we've heard that establishing a central point of contact at the foreign bank for the U.S. bank to ask questions specifically related to potential suspicious activity is a practice that helps avoid what can become a vicious cycle if the U.S. bank is unable to clear alerts because they can't get information about whether a transaction is suspicious or not. Then the default is they need to file a SAR. And then the more SARs that are filed on transactions that are associated with that correspondent banking relationship, the more likely it is that ultimately the U.S. bank will go to a decision of closing that account. So avoiding that by having a channel for sharing information and getting those questions resolved is a leading practice that we've also identified.
Lisa?
One last leading practice that I would say, because before the crisis versus 2017, I don't think that any bank looks the same. And so certain banks that we supervise have been engaged in foreign correspondent banking relationships. And two good practices. One, understand the respondent institution. What is their business model? What types of transactions are they processing on behalf of the bank? If necessary, depending on location of the institution, a site visit, but by all means, do some due diligence. There is open source data to evaluate information. If you can't get it, the bank will provide you with information, but validate some of this information, do some searches, rather than just relying on information that may be provided, particularly when you think that there is a higher degree of risk. The same way an examiner will collect information but do transaction testing, a bank can similarly do some good research on the business model, the country where the institution exists, and often you're going to find a lot of information. Some governments don't publish enforcement actions, but you can find some information out there.
Sarah, go ahead, Rick. First, then I'll go to Sarah on a different issue, but go ahead.
So I just want to challenge one thing that was a best practice, and Spencer, I believe it's in the guidance. So this notion around creating a documentary trail on why a bank would decide to exit a relationship. So I continue to be troubled by the fact that we have to document business decisions to exit when it is our decision at the end of the day whether or not we want to do business with somebody. Now, if there is a suspicious activity reason for exiting a relationship, obviously we need to be documenting that, and we would do that by following our normal course. But I know it was raised in the guidance to create, if I recall, and please correct me, Spencer, if I'm getting this wrong, to create an audit trail for exiting relationships. And then Suzanne, you just mentioned the same thing on a best practice for doing that. And I'm just troubled by that because your best practice and your guidance translates into an auditable event for banks that are doing business. So we are now getting audited, and then it's raised in audits that we haven't followed the guidance, and then that shows up when the examiners come in. So it just seems to be going down a rabbit hole of what's the legal justification for that?
So I think that one way to look at it is in light of other risk areas and other products and services. So I don't think there's a bank in this room that doesn't have an established process with specific lending limits for when you would onboard a customer and make a loan, right? Everybody knows what your underwriting parameters are. Everyone knows who has what lending authority, when it has to go to committee, who gets to approve it or not. And I think it's applying a similar practice to these kinds of decisions for key customers or relationships.
But lending brings risk to the organization, so you obviously need to have that. This is deciding, so I view that as apples and oranges, because this is deciding tomorrow that I don't want to do business in this example with Bank X that's sitting in country Y. That's my decision. Why can't I just do that? What's the benefit to the institution for having a process that you're describing for lending, which does bring substantial risk to the bank if they don't lend appropriately in exiting a relationship?
So I think it's important internally within, you're right, it probably doesn't necessarily change the supervisor's assessment of it, but it might be useful for the compliance professionals or the business professionals within a firm to have it clearly defined whose responsibility it is to make those decisions, whether it's onboarding or exiting or maintaining. What we do see sometimes when there is a risk, although you're right, not credit risk, money laundering risk, and things go badly, then nobody remembers whose decision it was, or it then ends up in the compliance department's lap as far as potential blame. I think it's part of a bigger discussion about accountability. This, in my mind, ties to some of the things we were talking about culture and governance. And we have been looking at AML issues and compliance issues within the broader lens of what I would consider governance. I'm not sure how one examines for culture, but you can examine for governance, meaning that what is the role of the board? How do they provide oversight? Are they engaged? What information are they getting from risk management and compliance? We often hear that compliance is everyone's responsibility, compliance is everyone's business, but then if you look at whether it's incentive compensation decisions, whether it's performance evaluations, who is held accountable for compliance failures at a firm? Who pays the price? If it truly is everyone's business, then you would expect to see an impact on the first line, not just the second line or with the compliance structure. So I understand your perspective, and it is a level of formalization, but I think it can be useful, especially for certain customer categories or groups, that there's a lot of these concerns.
Agree to disagree, it sounds like, for this. What I want to do is jump to the second poll question, but I want, Sarah, you to talk about it. There was an issue you had raised when we did the pre-call on accounts held by nominees, and then any other guidance outside of the AML priorities letter that you've issued that you want to highlight. But let me first put this poll up. And the polling question is, the biggest risk to my institution, firm, or client is resources, lack of skilled staff, we talked about that, overall training, corporate culture, which we've talked about, and regulatory expectations. So we're going to leave that up. Obviously, all challenges. Well, what's the biggest risk that you see here in the audience?
That's just the first person.
They love you guys. They love you guys. So, Sarah, in addition to the priorities letter that you issued, any other guidance documents you want to highlight? And then, of course, the issue of accounts held by nominees.
Right. So in terms of guidance, there are actually two things that we are updating this year. The first is our small firm template, which is a kind of a template procedures that smaller firms can use as a basis for their AML written program. So that is something that we're updating this year to the extent that you have particular requests or things that you want us to consider when we're updating that. Please feel free to get those to me. The other thing is our list of red flags, which we have included in several guidance documents, including the small firm template. We are updating that this year. So again, to the extent that there are things that you'd like specific guidance on, please please let us know about that. And as you may have seen, FINRA just issued a regulatory notice last week asking for general information on kind of how good of a job FINRA does in communicating with its members and how we can do better in that. And so that's not AML specific, but I'd certainly draw your attention to that. And to the extent that that's something that you'd like to offer us feedback on, that's something that is very much of a priority for FINRA this year and our new president, Robert Cook. And so I'd invite you to look at that and feel free to offer your feedback. In terms of nominee accounts held by nominee companies, what we are looking for this year, obviously partly brought to light by the Panama Papers incident last year, but really a much broader issue than that, is really, to what extent are we aware, and particularly I would say in the brokerage industry, of accounts held by nominee companies. This is something that has been highlighted by OFAC and others as a real risk. This kind of the concept of this nested account, held nominally by an entity, but the true beneficial owner is several layers down. And this is something that we just wanted our firms to focus on, be aware of the extent to which they have accounts held by these entities, be aware of the extent to which certainly, many of our BD affiliates are assisting customers in forming these entities and then hosting accounts for them. So it's really just kind of an awareness issue. And I know we're running short on time, but I wanted to mention one other thing that I wanted to make sure that firms are drawing their attention to, which is systems issues. We've talked about it a little bit kind of throughout the panel, but kind of the importance of technology and how things have just changed so much. I think, Rick mentioned it used to be right. There was kind of technology over here and then there was AML over here and there wasn't necessarily a lot of interaction. We depend on these systems so much in AML. It is so crucial that you have a good understanding and real confidence in your systems. Your inputs into the systems, what is going in, are there certain account types, customer types, transaction types that are not being fed into your systems, and why? Once things come into the system, what exactly is happening? If you think that certain alerts are triggering, certain scenarios are outputting events, to what extent do you do testing to make sure that those are indeed working as intended? When we come in and do an exam, that's what we're going to look at. We're going to pick transactions that should be triggering and see indeed whether they're triggering. And finally, parameters. When did you last set your parameters? When did you last look at the parameters in your systems? Have you updated those? Have you considered whether it's necessary to update those? Has your risk profile changed? Your types of customers, your types of transactions, business lines changed since you updated those? They're so important. We rely on these systems so much, and it's so important to get these things right. So I want to make sure that you're drawing your attention to those things.
We have about 10 minutes. Going back to the poll, 40% says reg expectations, but 28% resources. So I would take that as a challenge for the next couple of days to talk to your peers and colleagues here at the conference and see how they're managing that. Obviously, that is an ongoing struggle. Do you have enough resources and do you have the proper resources? And resources are a combination of staffing and systems, right? I think that's both. So a number of the topics that we had listed are going to be covered throughout the conference. We've already sort of talked a little bit about financial inclusion. Big session coming up next. FATF, our good friend Rick McDonald is going to be doing a panel on that later. But there is, we do reference geographic targeting orders, Jeremy, and the reason that's there, a number of reasons, but one is this is an old tool that was somewhat revised the past couple of years. But for my money, I think it's actually a very focused tool that makes sense given you do your due diligence and you decide to go in certain regions and get additional data and do things with that data. Describe a little bit the targeting orders, and if you can, are we to anticipate more, which I would expect that we would depending on activity, but what can you tell us?
Well, I think you make a good point that we're trying to use our authorities to the fullest extent. And these are primarily information collection authorities. They've been on the books for quite some time, and we just want to be able to use all the tools that are available to us to move the ball forward on anti-money laundering and fighting this type of risk. These specific orders are targeted for specific regions. They're targeted for specific transactions. That is, cash transactions in the real estate market. Cash will mean not financed by a mortgage. And we've asked title insurance companies to provide beneficial ownership information. So it's targeted at the audience, it's targeted at the type of transaction, and it's targeted by location. That's a really interesting tool. It's one of the only tools that I'm aware of that we could target things that finely. I expect at some point in the future with similar risks, we will use the tool again. In terms of the GTOs that we have out now, as you know, was just renewed in February. And we are exploring what this data tells us. In a review of the first 2 GTOs, we discovered that of the individuals identified as either beneficial owners or facilitators of the transaction, 30% had SARS filed on them, independently of that transaction. Now, SARS, of course, are not indications of specific crime. They're suspicious activities, but it's still interesting enough, and that level of involvement does warrant further investigation.
So we have time for some takeaways. We have a couple already. Proactive risk-based internal controls, including change management processes commensurate with your risk. It's Spencer offered up. As Rick and I and others have talked about, don't wait on CDD implementation. There'll be, again, a session at the conference. And the overall notion of communicating with examiners, obviously an obvious statement, but one that I think sometimes gets lost, both the understanding different products and delivery channels, but also what you're doing. I think Lourdes made a great comment about governance. You have these things in place, but you're not really doing what you say you're doing. So I think all that stuff is pretty important. So I'm going to go down the row here, and any additional takeaways. I should also mention, as an aside, Sarah talked about the Panama Papers. It's been a year today when they were released. There'll be a session tomorrow talking about that. I did hear from a number of AML professionals that said, they sort of started to see, and this is an overstatement in my view, a decline in emphasis in AML and BSA, and then Panama Papers kind of ratcheted everything up again. I think that's, again, a little bit of an overstatement, but clearly it did do something rather dynamic globally. And so again, a year ago today, I know there's actually a program going on in London as we speak. Transparency International has been sending things out on social media about it, but we'll cover that tomorrow. But a major change in how we perceive things globally, I think we can safely say. But other takeaways, Lisa?
One statement recently, our chairman delivered a speech and stated that the resources dedicated to AML, CFT compliance has grown over time as the scale and nature of the threat has increased and become more sophisticated. We recognize that on the panel. You recognize that because you're in the field. What we look at is, one, not only that you have policies and procedures, but that they are appropriately applied, that they cover the risk in the institution, and if your risk profile has changed, that you make the necessary adjustments. And we don't just look at the BSA AML staff. We look all the way up. We look at senior management, and we will look at the board of directors to make sure that there is appropriate attention given to this area, just like they give to all areas. And not a threat. It's just what we do when we examine institutions. We look all the way up to make sure that all relevant areas have the appropriate attention, and when there are problems, all the way up, that senior management can execute changes and that the board is aware of a need to make changes. So my takeaway is we look at compliance and we look all the way up.
Look up, right. Want to add anything, Spencer?
Yeah, related to this discussion we've been having today about the changing role of BSA and the role of the BSA, the AML officer. I think it's important to take away from this that the AML officer needs to be propped up and have appropriate stature to effect change. The BSA, AML, I view the BSA officer as a BSA officer, the AML officer, and the CFT officer, to be frank about it. And in that role, that means they need to be involved in product development. They need to be involved in client onboarding or in client decisions and so forth. to some degree to at least weigh in. So they have to have the proper influence in the organization. I think that's extremely important.
And also to protect them in case of personal liability. If you're going to get that personal liability, you better be able to affect change,
That's
right?
a great point.
Lourdes.
So I've been reading SARs lately with respect to elder financial exploitation. A number of us at the SEC have been doing it. And I want to thank the firms that are filing them. They're very well done for the most part, and that's really very helpful. And I also want to encourage firms, don't just put boilerplate when you do a SAR. Try to really identify the suspicious activity. Otherwise, it's very hard for us as securities regulators to be able to use that SAR. And at the end game here is to be able to use these SARs.
Great, thanks. Sarah.
I would say, we talked a little bit about independent tests. Leverage your independent tests in your internal audits. I have to go through internal audit review, not quite like you guys do, so I am sympathetic, and it is no fun. It is no fun process, but it can really be a tool to the extent that you have areas for improvement in your system. It can really be a tool for you, a blueprint, something that allows you to go higher up the chain, to go to your board if necessary, to ask for more resources. It's not fun, but if you have a really good internal audit, if you've got a really good independent test, that can really be a good blueprint for you. When we come in as examiners, there won't be any surprises. You will know what you need to do to improve, and hopefully you'll already be working on those things. So embrace that pain. It's not fun, but it can be helpful.
Rick?
I'll embrace it, thank you. So I think, and everybody's mentioned it already, but I think it's important to mention from the institution side, document your processes, document your procedures, and make sure that you're executing the way you documented. And the addition I would add is, if it's not happening the way you documented, change the process, change the procedure, make sure you document what it is you are doing, have a change control process to do that, but don't get stuck in the rut where you've documented something one way and you're doing it another way, and that other way is working, but you haven't gone back to adjust. So documentation is key.
Jeremy.
I think I would hit on the theme of leveraging the expertise of others. And that doesn't just mean communicating with examiners, it means communicating with everyone. Internally, you're talking to your fraud groups, you're talking to your InfoSec groups, your IT groups. Externally, you're using 314B to the fullest extent that you can. You're talking to us, your regulators, through either our helplines or things like the Bank Secrecy Act Advisory Group. None of us can do this by ourselves. It's important that we all are on the same page, that we're relying on each other to build a stronger framework.
Great, thanks. Suzanne.
Okay. Well, building off the last point, there was a reference to rogue examiners. I mean, certainly none of us could guarantee that every word that's uttered by an examiner is perfectly consistent with, what we say in Washington or what we say in guidance. We certainly put a lot of effort into having consistency, especially when things get elevated to an enforcement action or other remedial action situation. So my takeaway is that examiners are not the enemy. The purpose of the exam, the role of the examiner is to ask questions. That doesn't necessarily mean that there's a criticism. It is really an opportunity for you to demonstrate to the examiner, whether it's in written policies and procedures, whether it's in the practices, or whether it's just an explanation. Explain your perspective on the risk that's reflected in your risk assessment of your customers and your products. Be able to show how your internal controls have been designed to mitigate that risk. The examiners go into dozens of banks or other financial institutions every year. They don't know your institution the way you know it. And it is an opportunity for you to demonstrate with a level of thoroughness that somebody told me once, you want to have a bored examiner. You don't want an excited examiner. You want to bore them with the thoroughness of your procedures. And so I think, that would all be very helpful, so you can all come to the conclusion at the end of the exam that the system of internal controls, the program, is commensurate with the risk posed by your institution, which is the goal. And as an add-on to that, I would say for those of you from the government agencies that the compliance officers are certainly not the enemy either. And the only folks that win when we fight each other are the bad guys. So leave you with that.
So I guess we're going to go out hugging on the way out.
I was thinking kumbaya, yes.
I want to remind everybody, use the mobile app, the evaluations. You'll also get an evaluation at the end of the conference, but give us feedback throughout the program. After the network break, which will be in the exhibit area till 11:05, you're going to have a can't miss session on financial inclusion and access issues that are global that we all face and all struggle with. So the exhibit hall now from 10:35 to 11:05, and be back in here, and let's thank the panel for this morning.